Good evening. Pretty exciting Saturday night here. Decided to start next week's lecture a little bit earlier just because, schedules are shifting and all the rest of that. What we're going to talk about tonight is stocks and bonds. So, kind of a follow up to the basic investing that we were discussing. We talked about investment fundamentals, investing in stocks. And like I say, most people say or might think that this is kind of down in the weeds, that they might not ever be buying individual stocks, and fair enough. You probably are going to be a sounder strategy would be to use mutual funds as part of that sort of segment. You'll probably end up with different investments as you go through life. A little bit of diversification. So you want some money probably in equities. Part of companies, corporations, and you can either buy direct stocks, small chunks of individual companies, or like I said before, we'll talk more about mutual funds. You could buy them under a mutual fund and have it managed, and it's just a little bit more user friendly, and doesn't you got other things to do with your life other than maybe chase individual stocks. But if you do find chasing individual stocks, not only can it be interesting, but it can also be kind of motivational. If you are doing that, I mean, that's one of the reasons why I ended up with more money in the market is because I found it more fun as opposed to a mutual fund where it's just a payment. But other people get fun from other areas. So we're going to talk a little about stock exchanges. The book kind of presents things in an old school kind of way where the internet has kind of passed them by. So I'll fill in a lot of details in terms of how things are done. Like stock exchanges. Yeah, there's the New York Stock Exchange, which is kind of the big place where a lot of large companies are traded. But I don't have much that's traded on there because they are kind of the big stock exchange. Most of the stuff I trade on is on Nasdaq, which is a kind of a virtual stock exchange. It doesn't have well, it has a physical building somewhere, but it doesn't have goofy guys with screaming out orders and doing all that kind of stuff. It's done mostly electronically, and it trades a lot of new and emerging companies and stuff. So to get on the New York Stock Exchange is good because you have to have certain requirements financially. There's not too many flaky companies on there. At least they aren't when they are initially listed. But I've had companies that are on there and they get delisted, which is that's not a good sign. Anyway, so floor traders, kind of go in the way of travel agents and bank tellers. Most of it can be done more efficiently electronically, but they'll still stay around. Specialist traders who help make a market. So, I mean, believe it or not, these people that are sort of the vultures looking for good deals, they're a necessary element of the market. I mean, without those folks, when the stocks go into free fall, they would just keep falling unless there was, somebody willing to buy them at a lower price. And anyway, right now there's a few politicians and some other people have done some unscrupulous stuff, but there's also some genuine traders who take positions out there and make the market a market, where there's always buyers and sellers. Other stock exchanges, yeah, you'll American Stock Exchange, other regional ones in U.S. cities, certainly. Now, the one thing that, if you see something traded on, like, let's say the Hong Kong or whatever, I guess it's the Nikkei, or Frankfurt Exchange, you don't want to be doing that directly for the most part, because you end up with all sorts of tax situations and things like that. A lot of those foreign companies are also listed on American exchanges, and so you would be far better off to purchase them there, because that way you avoid all the currency hassles, you avoid all the tax hassles. You would just be creating kind of a storm. When I was in Germany, in fact, even though I still maintain a German bank account, I could not buy um, stocks or mutual funds on the German exchanges, even though I was living there, and I wasn't a resident, but I had certain rights from being a um, from living there. Um, anyway, but I'm certainly glad I didn't, or was at least prohibited, because you don't need to do that. If you see some foreign company, or you think that there's a opportunities in another nation, um, you can trade on that, but keep it here, um, through U.S. exchanges, and you'll be better off. And then OTC. So that's what I was talking about with NASDAQ for the most part. Over the counter electronic communications networks. So just because of speed, because of everything else, I buy and sell stocks quite frequently, and they're you place the order and boom, you get the confirmation right back. There's not a person involved, and that's a good thing, because people in this kind of thing can only really kind of screw it up and charge commissions. So I'll show you just some of the things that are available. After hours trading, I typically do not do that, but I mean, you could. I think that's kind of the way of the future. But most of the time, since we're 4 hours off the East Coast, the markets here, you know, in Alaska close at 12 o'clock local, which is, whatever, 4 p.m. on the East Coast. So, but there is that possibility, and Bitcoin and things like that are certainly traded all hours of the day. It's going to probably come, full circle once everything becomes a little bit more automated. There's no need to have those business hours. There's some holdovers, like when you sell some stock, it takes a couple days to settle. Well, electronically, there's really no need. This is just the big banks playing games, holding your money for an extra day or two before they put it in your account. There's no necessity for that, but there's certain holdovers that those people are not going to give up easily. Stock quotations. So when you're looking, in the old movies, or like when they talk about ticker tape parades in New York, they used to have ticker tapes, and actually there's still money in that. I mean, that's how Bloomberg got all his money, is financial publications and financial terminals and things, because literally, if you can get the information nanosecond quicker than the competition, you can make a lot of money. So there's money as information. And a lot of times when you used to get stock quotes, they'd be delayed at least 15 minutes. Now you can get real-time quotes, but real-time is a notional thing when you're talking, or a relative thing when you're talking. Other places have fractions of a second, even have their computers, like the cabling, a couple feet shorter. I mean, it makes a big difference to these folks in terms of the speed, and we're talking electricity, it travels at the speed of light. So anyway, interesting stuff. Information, and now the big revolution here, though, is these old quotes are they're just archaic now, with all the nice charts and interactive nature of all that. The regular quotes out of newspapers are just silly. This is silly, okay? But what the basic information is going to be the same. This was the high and the low over a 52-week period, right? That's the stock. Used to have to know what the ticker symbol was, like F is Ford, and Shop is Shopify, a company I've talked about a few times. And here they are paying a dividend, a yield, price to earning ratios, which depends on the type of stocks. I really don't worry about that for the stuff I'm doing. Volume. Sometimes you'll see a big price change, but you'll look at it and it's like the day before Christmas or something. And so if there's very little volume, well, then there wasn't much of a market. And so, anyway, the price gets distorted sometimes when that happens, just because there's not enough people in the market. So if you see a huge price change on some stock, and volume's relative to itself. I mean, if it is 9,000, or times 100s, is that a big number? depends what it was yesterday. You know what I mean? So a lot of this is kind of something if you studied it day after day, you'd see trends, but it's just really hard to get much information out of tab data. In fact, let me switch. I've got a few things loaded up here so I can just show you how you would properly do it. So like see here is a Shopify. Let's see if we can get this thing to go bigger, full screen. So it's an interactive chart. I absolutely don't care. I mean, Yahoo Finance, I would not read the news off Yahoo or whatever, but for financial stuff, it's all numbers. There's no opinion here. This is strictly tabular data. But you can see compared to it's derived from tabular data, but you can see the power of an interactive chart. So I can say, okay, oh, things are looking pretty gloomy right now in the stock market. But if I look at a 5-year period and I go back and I can see, whoa, we've already had a V. We have already got some sort of recovery going on. It's up to $421. It's already above where it was back in September. So, if I would have panicked, if I would have sold somewhere in here, somewhere back here, yeah, I'd be hating it. Now it's starting to recover. And so, again, this is something you have to look at with stocks. You kind of have to have the stomach for it. And you also have to make sure that you're trading with money that, you don't necessarily need to buy your groceries with this week. I haven't looked at this stock data just because I'm not selling. I'm not going to be selling for years. So I'm not going to, get all frustrated and obsess over things. But let's look at a more, this is Ford. Now, this would not be a company I would be investing in for a number of reasons. But again, look at this 5-year trend. And Ford products, I mean, I know people like Ford trucks, but it doesn't seem like that's a very healthy company to me. Let's go back to shop, a little brighter. But anyway, you can see down here on the bottom, you've got, I believe these would be volume numbers on the bottom. You've got you'd want to know who's saying it's bearish, who's saying it's bullish. There's some opinion coming in there. Some of this technical analysis, that's where you're getting into some opinion stuff that I would want to know the source of that before I put great stock in it. But what I am saying, though, is compared to just looking at a newspaper and seeing a price and seeing a volume number, most of us work far better, graphically, and we can see things. So, okay, back to the slides. So that's kind of the old school here is with the newspaper, and the newspaper obviously is a day late by the time you get it. So, again, not very good. Purchasing and selling stocks. So again, brokers, I don't have a broker. I've had a broker and I never ever liked them, tell you the truth. And the brokers like I used to have that made recommendations. The reason I kind of got out of that and they just kind of went away was this traditional thing. I was overseas at the time, so I didn't have access to the internet on a regular basis, and I was having to go off other people's opinions, and so they recommended a few stocks, and sure enough, I'd buy something, and the price would sort of tend to go down. This happened to me about 3 occasions, and then every one of these occasions, I got a letter, about 6 months later, from a class action lawsuit from other people who invested in this stock, basically saying that I think it was Payne Weber or E.F. Hutton or whoever, they were all kind of in it, but they misrepresented the stock. They had positions in it that they didn't let people know about. And anyway, it's kind of hard to explain here, but if you watch The Wolf of Wall Street, you kind of learn about pump and dump and how things get manipulated. And anyway, it's not good. So I rely on other sources of information. And again, I'll show you a couple sites that you might look at. There's a whole bunch of products out there available. Must disclose, yeah, but sometimes I don't know if they were required to do that back when I purchased from them. It's been several years, but that's part of the reason. Individual broker skills, again, brokerage commissions. So does not offer investment advice. Again, what I was saying when the investment advice really wasn't worth it. Full service brokerage firm. This can happen, but keep in mind, know where you sit in terms of uh, your position with getting advice from a brokerage firm. You may have a couple $1,000s, a couple $100,000. You may think you're a relatively big fish, but what I found again was most of these guys they had their high net worth clients that have millions of dollars, and they get the time, and an individual investor, a small time guy, they really just couldn't be bothered. So, but anyway, if you were somebody in that kind of high wealth position, yeah, you might have a get some service out of a brokerage firm. Placing an order, dead easy. Um, Ticker symbol, or just type it in. I'll show you how to do that. Buy or sell, numbers of shares, um, round lots, odd lots. This has kind of gone the way of whatever. People don't care about that anymore. Most stock, brokerages. I tend to buy in amounts of around $3,000 because that's kind of what I consider a reasonable amount. It's just what I've kind of always done, and so, but it doesn't need to be that. But anyway, you'll get into the uh, menu there on the brokerage, and it will auto calculate. You put in there how many shares you want to buy, but it will also give the option of saying, I want to spend $3,000, and it'll do a little calculation, say, hey, you want to buy, based on the price, you want to buy 31 shares or 33 shares or whatever. So this notion of odd lots and others is not such a big deal now. If you want to buy 7, if you want to buy 17, um, in the electronic trading, they don't care. Market or limit order. So this is definitely a thing, as is stop orders. So this is kind of cool. If let's say you see a price, you're the market's open, and you want to buy some stock, and let's say it's trading for $30, and I used to trade a lot of Twitter back and forth because Twitter was really hard to put a price on, and it seemed to go this range from $30 to $60. And so what I would do is I'd buy at 30, and then I'd sell at 60. And so I would just kind of watch it, and when it got down to $30, around about $30, I would just put in an order and buy that stock. And so when I just put in an order like that, that's a market order, right? Now, let's say it was trading at, pardon me, 35, and I know it's probably going to bounce down to 30, and when it does, that's when I want to kind of pull the trigger and buy those shares. I can put in an order like that, a limit order, and I can put, buy 100 shares of Twitter when it hits $30 and walk away. And I can put in a few other caveats. It'll ask me whether it's GTC, which means good till canceled, or whether it's just for the day. And anyway, all this is, you don't have to remember any acronyms. It's all on their sites, but I'd usually put good till canceled, and sure enough, a couple days, a week goes by, and all of a sudden, boom, I get an email telling me that the stock price dropped to 30, and I bought. Hopefully, it did what I was saying, and it turned right around and started on up to 60. That's why I say I used to trade Twitter, because one time it got to 30, I bought, and then it dropped all the way to 22, and then I owned Twitter for probably 6 months before I could dump it again. But I successfully did that 30 to 60 range probably 5 or 6 times, and that was cool. But something changed, and fair enough, I'd moved on from there. But anyway, that's how you can use market and limit orders. Then you can also use a stop order. And let's say we're doing the same Twitter game, and we know it's going from 30 to 60, or we've kind of seen the trend. So it's say it at $50. And again, I got things to do. I don't want to sit here and watch it all day. So I put in a sell order for, well, I could put in a sell order at 60, or now let's do a stop order. So what I'm going to do is I'm going to put in a trailing stop. So let's say it marches on up. It's at 50. Now it goes to 55. I'm expecting it, if I'm right, it's going to march on up to 60. So I don't necessarily want to sell just right now. But again, if I'm wrong and it starts to drop, I bought this stuff for $30. It's trading for 55. Let's say if it drops back down to 50, well, then obviously my numbers are wrong. I misguessed this thing, and I want to sell, so I at least lock in, $20 per share profit. So I'll put in what they call a trailing stop. And so when the stock's tooling along, it goes to 55, and then something bad happens. Boom! All of a sudden, it starts to descend. It hits $50, and my trailing stop, once it gets to $50, now is executed. It essentially becomes a market order, and I'm out of the market and good. Well, there's the other scenario here was is it's at $55, and I am right, and all of a sudden it starts creeping up to 60, and okay, I could sell right at 60. That was kind of my goal price. Or I could be, a little creative here and say, well, I'm gonna put in a trailing stop now at 55 because I think it might go even higher. But if I'm wrong, now it's going to hit that trailing stop at 55. But let's say it continues on up. It goes up to 65. Well, now I move my trailing stop up to $60. And let's say it goes up to 70. Well, now I move my trailing stop up to 65. So there's a lot of strategy that can go on here. And you're trying to work on whatever information you got, but part of it is just a hunch. The other problem with my strategy there with the trailing stop is I set like a $5 drop, before this order gets executed. And that may or may not be too small of amount. There may be volatility within the day where the stock price might dip to 55. My order gets executed, and then boom, it starts marching back up to 57, and it ends up at 60 by the end of the day. So there's it's a complex thing, but that's why if you're trading stocks, it takes a little bit more attention than just trading mutual funds. But my point again here is that if you understand how stocks are sold, then you'll understand how mutual funds, when mutual funds are comprised of stocks. So, you'll understand when the manager of that mutual fund, when he's executing some of these more complex orders, that, what he's doing. And so you'll have something there. So this one they executed when a stock reaches a specified level. Yep, a limit order and a buy stop. So they can be sell stops, buy stops. Yep. Placing an order online, low commission, and realistically now it's no commission, so that's good. Buying a stock on margin. So again, this is personal finance. It's not, personal speculation. When you're buying stocks on margin with borrowed money, that can be very bad, very dangerous. What happens is, the Federal Reserve. So this isn't something that, a brokerage can have a different requirement. Nope, the Federal Reserve has a 50% margin limit. And then if you can't meet that, then you have a margin call. If you can't figure it out, if you can't get them more money, then boom, they just sell your stock. And your stock was probably at a very low price. So let's say you had, you're trading on margins. And I just said, for me, I said, I'm just watching the Shopify. well, I'm not really watching it because I'm not selling at this point. If I had bought that stock on margin, um, I could have been in a very bad situation because I wouldn't have been able to meet the margin call. So what happens is when you're buying stock on margin, this 50% of the cash. So let's say you just we need to put concrete numbers on this. Let's say you buy $1,000 worth of Shopify, for example. Okay. Um, if you're buying it on margin, you would at least need to put up $500. Now that's your collateral, basically. That's the 50% number, but it's denominated in Shopify stock, which is bad because when the Shopify stock goes down, um, it's no longer worth $500. And so let's say it's down to $400 because Shopify's prices is down by 20%. You need to buy more Shopify stock at that particular point to get back up to that 50% level. And if you can't make it, if you can't get to that 50% level, then the brokerage by law has to sell your shares. And they're selling them at the bottom. So buying on margin is, it's using borrowed money to buy stocks. So using borrowed money to buy real estate it's the way it's done. And it's not a big deal. It's not a risky proposal. Buying stock with borrowed money is a risky proposal. So we're not going to do a whole lot of that. Short selling, same sort of thing. A little bit beyond, again, this is speculation because it involves really market timing, and that's hard to do. There's some people who made a killing on this market, going down, some of these hedge fund guys, but there's just a few of them. There's quite a few who lost. I've done this one time or a couple times. I bought some Tesla stock, and I was expecting it to drop. It was right after the Trump election. I expected him to get elected, and I expected the subsidies to Tesla to kind of hurt the company a little bit, which it did. People were not as they didn't expect as much investment in Tesla. That was a snapshot in time. Tesla has changed around from them. They aren't as reliant on government subsidies as they once were, but at that particular time they were, and so it's a complex thing. It'll kind of you got to think about it because it'll kind of tube your mind here. What you do is you in essence buy some stock. So you buy say 20 shares of Tesla, but you don't pay for them at this time. You pay for them in the future at a price at the price at that time. So, you own say 20 shares of Tesla, but if the price drops when it comes time for you to actually pay for those shares, if you did it right, the stock price will have dropped significantly. And anyway, it's a little more complex, and we're not going to go into huge details on it because again, it's kind of beyond the scope of personal financing. But when you're shorting something, you're expecting for that price to drop, and that's how you're going to make your money on it. I mean, it's fun to do but do it with small amounts of money, and this is not something you would do with your primary retirement, nest egg. So, all right, technical analysis, different ways to analyze stocks. The technical analysis, these guys a lot of times will just look at charts and they'll, derive all sorts of information from just the chart alone, not the products that are coming out, not the current economic conditions, not the future outlook of the company. They'll just derive it from charts, which I've never been one of those people because, I'm more of a Warren Buffett kind of person Warren Buffett, Berkshire Hathaway, the Oracle of Omaha. He's done very, very well, and he buys things like, CSX trains, and he owns Tony Lama and Justin Boots and all that other kind of stuff that, people in kind of the Midwest and the Heartland kind of need and rely upon. But he makes some smart decisions. For example, he saw the whole fracking situation taking place. He knew that oil capacity or oil production was going to be greatly increased, and that there were going to be problems, with pipelines, with transportation, and the only thing that was really available to, trans uh, used for transportation for a lot of that oil, transport that oil, was going to be railroads. And so he bought big into that and obviously did quite well. So that's, he would not be a technical analysis guy. He would be more of a fundamentals kind of person. Analyzing financial condition. Again, it's kind of comparing, you need two companies to kind of compare against each other. And to tell you the truth, a lot of times, I don't try and do this stuff necessarily on my own. I generally, if I'm interested in a company, number one, I want to see, a recommendation from another, from a third party. I'll talk a little bit about some of those third party type things. But then I also want to see a reason, a tangible reason why I would expect that price to go up. Twitter for me was kind of an exception to that rule because, but the thing I liked about Twitter was it was so hard for anybody to put any valuation on it because it didn't really have anything tangible. It didn't really have a product, and the traditional investors kind of stayed away from it. So it ended up in this speculative thing with this super volatile price, and there was an opportunity to make money on that, but not in a traditional way. Their balance sheet, their income statement is all pretty sketchy. All right, so ways to look at a firm's performance. Anytime you're valuing stocks, you're looking at their future performance. Historical information is semi easy to get, but what you're talking about is the future of the company. And obviously people aren't really hot on Ford, to tell you the truth. When we're looking at that price where it's just sort of in descent there, I don't think people would be very bullish, very, very positive towards that sort of outlook. So a lot of it is the psychology of it as well. If they have a product that's doing quite well, like for example, Lululemon was a company I did pretty well with, and just being on campus when I was teaching full time at UAA, I would see so many students and my daughter and everybody else with Lululemon products. And then also it came through as a recommendation, and the price did go up. So Lululemon had some strange things going on in terms of its CEO was making some kind of weird comments and stuff like that also kind of affected the stock price. But in terms of their product and in terms of the marketplace, it was quite strong. Accounting fraud, yeah, this will happen. Comes back and forth. I'm not at all worried about manager compensation. It's a competitive world out there. I want these guys who run the companies and make quite a bit of money. I mean, probably one of the smartest guys I know ever met was an old roommate of mine, and he was in the Air Force, and he was just a super genius. And now he's the he's the president of Raytheon Space. So, I mean, he makes 5.3 million a year, and I think he probably deserves it because somebody else would pay him that much money to run their company. So, as long as the person's getting the results, I'm not going to begrudge somebody for making money. economic conditions. So right now, this is a strange time to be talking about these sorts of things, but in the long term, and even that rebound that we're starting to see, I think we're going to be just fine. But it's kind of hard to. You got to be an optimist at this point. GDP, the gross domestic product, yeah, it's going to certainly take a hit over what's going on right now. Fiscal policy, but the Fed, the government, the politicians seem to definitely be pumping some money into the economy, trying to get things going. Impact of international economies. That's one of the best things the U.S. has going for it is the weakness of all these other countries. So we're pretty strong, but our strength is even more important is the weakness of the other nations. Europe's been kind of in the gutter, and um, I think Asia's taken some hits lately. China's certainly down, so we'll see what happens. Stocks perform best when interest rates are low. Yes, they do, because companies can borrow money. Some stocks more sensitive, certainly, but the overall economy, is accelerates rapidly when interest rates are low, and then the Fed tries to use monetary policy to influence. Well, yeah, to influence. I would say to try to influence because it's not a direct relationship. Um, they do their best, but sometimes they can only do so much, and then they pump so much money in there it just doesn't change much. But if you ever hear somebody talk about the Fed, what they're talking about is the Federal Reserve, and the Federal Reserve sets the rate of interest that banks charge each other, um, and so that sort of sets the tone for the interest rates and the rest of the economy. We could spend a whole course on the Fed, but anyway, it's a pseudo governmental. Yeah, its place is hard to explain. When Trump or somebody says he's going to fire the Fed chairman, he can do certain things, but they've got some independence to them. Inflation. So we haven't had inflation in a long time. So this is, this course would be very topical. Bonds would be more important, and inflation would be more important if we had any threat of inflation or increasing interest rates. Theoretically, dumping all this money, if it continued, would cause more inflation because obviously, the more money out there, the less it's worth. But um, I don't think it's going to go on for that long. Industry conditions, certainly integrating your analysis. So again, trying to do this all alone, I don't even know if you'd come up with the right conclusions. I generally, like I say, try to look to other folks, make sure it makes sense. I have a stock recommendation service that I subscribe to, but they'll probably recommend 10 stocks per week. And not that I'm buying stock every week, but there's only one or two of the recommendations that I would even act on, just because I don't agree with some of their analysis. But what I typically don't like to do is go against their analysis to buy something that's not recommended or they're negative against. I will question my own judgment and that's kind of worked out for me. Anyway, factors that increase or decrease a stock's price. So, yep, strong, low interest rates, low inflation, strong industry. So, and then everything else is going to cause a decrease. Analyzing stocks. Difficulty in forecasting. That's why there's money to be made. If it was easy, everybody would do it. Favorable attributes reflected in the stock price. So again, stock prices are future looking. So before we jump into bonds, and we're not going to spend that much time in bonds because they're just not the place most people want to be at this particular point. So for one source of, better financial information, again, they're not going to give it away for free, but Barron's is a pretty reputable, um, newspaper. It's a not newspaper. It comes out, I believe, every other week or something. But now that's got an online presence. But this, is a little bit more in depth. I prefer it over Wall Street Journal as well. So that's just one place to get some financial information. When I talk about recommendations to actually buy stocks and stuff, Motley Fool is a company that's been out there for a while. There's other people doing sort of the same thing, but these guys are, kind of with it and hip. They got marijuana stocks and tech stocks and other stuff, and they'll have some information. Again, anything worthwhile is going to be behind the paywall, and they'll have some of these numbers out here that, you know, people who have used their advice. They've got a bunch of different products, Stock Advisor, and uh, uh, used to have hidden gems. Now I think they call it rule breakers. But anyway, different people with different objectives. But the S&P, the Standard & Poor's 500 is up 74%, and these guys are up 326. So, if you had this, and anyway, a lot of it's buzz. But for Stock Advisor, they're looking for growth companies, but larger ones. So you don't have to be a rocket scientist to figure out that, hey, Apple and Amazon and Intel, this very much in the tech sector. And they've had some losses. Look at that, lost 41%. That's the year of the big real estate meltdown. Other years good, some years better. Anyway, just one different thing. But you'd have to go through and look at some of their programs. So yeah, those are the two that I have. Rule breakers and Stock Advisors. Not for everybody. Definitely going to be a turbulent kind of thing. Morningstar, a little bit less speculative, more of a big boy approach, and they specialize in mutual funds. Again, these guys aren't, they've got all these ads here, but they're not their own product. They've got what they sell is advice. They don't sell stocks. They don't have positions with these companies. And again, if you want something worthwhile, you're gonna pay for it. So you could do a free trial or something else. But other companies out there, but you're not totally on your own, is what I'm trying to say. And then when they're talking about commissions, yeah, commissions are now, and this is pretty much across the board now, where these companies are going to this model. The one thing I like about these guys is they actually have a branch in Anchorage. I've never done anything other than drop off a check, but it is kind of nice to have that availability. But you've got so many different options when it comes to these companies, and dead easy to open up account, and they're going to sell you. But again, of the big companies, I don't think you can go wrong. And you don't necessarily have to have a personal relationship. If you want to talk to a broker, it's kind of like a travel agent, where you want to speak to somebody in person. Okay, we'll hold your hand, but we're going to charge you $25. And they could do whatever you wanted: ETFs, exchange traded funds, mutual funds, options, futures. I mean, you can do some crazy stuff here. Be careful with that one. Futures are just very quickly. I didn't really talk about futures and options. What happens is, let's say you're a company, let's say you're Alaska Airlines, and you got to buy fuel for next year. Well, you're selling the tickets already. A year out from now, you look at spring break tickets, you can buy those at a set price. So Alaska Airlines, for example, is in the aviation business. They're not really in the fuel speculation business. So if they want to offer a price a fixed price right now would be very difficult for them, not knowing how much jet fuel is going to be, since that's a big component of their expenses. So what they will do, and let's say jet fuel right now is going for, I'm just guessing here, let's say $4 a gallon. Um, if they want some stability in their fuel pricing, rather than just wait till next year and see how much it's going for, they can do that, but that's kind of risky. What a lot of companies will do is they will basically sell a futures contract, and they'll find some speculator, and they'll use an exchange like, say, Chicago Board of Trade or somebody like that, a big futures trading type thing, and they will sell a contract to buy 1 million gallons of jet fuel for $4.10 a gallon for March 2021 delivery. So they're somebody who buys that contract is obligated to deliver 1 million gallons of jet fuel in March 2021, so a year from now, at $4.10 per gallon. And if they accept that contract, if they do that, then by God, they gotta do it. They gotta deliver that fuel. Now, Alaska Airlines is kind of out of that. That speculation is done. They know what they've got to do. They're gonna buy that 1 million gallons of fuel, and they're gonna buy it for $4.10. Now all that risk, all that financial instability or uncertainty falls upon the investor who bought that contract. If jet fuel prices drop and they're down at $3.50 a gallon, the guy's able to buy that fuel for $3.50 and sell it to Alaska Airlines for $4.10, and he's going to make a bundle. And but if it goes up to $4.50, well, he's screwed. He still has to deliver that 1 million gallons, and he's only going to get $4.10 a gallon, but he's going to have to pay $4.50. So it's a contract, and it's a problem because it involves the obligation to deliver it, and the obligation is critical. You could do the same sort of thing if you're an investor and you want to buy something like that, but you could just buy the option. And what you could do here is you could buy, you'd pay a premium, sort of like an insurance premium. And in this case, you would have the right, but not the obligation to deliver fuel for $4.10 a gallon. So if the fuel is going for $4.50, you would just let your option expire worthless. You wouldn't execute it. And that company, whoever is on the other side of the trade, would just keep that premium that was paid. Conversely, if it's trading for $3.50 a gallon, you can go ahead and execute that option, and they are forced. The person on the other side of the trade is forced to purchase that fuel, in this case, at $4.10. So there's a lot going into that kind of stuff, but again, it gets into speculations. But when you see futures and options, they're related, but futures involve an obligation, and options involve a right, but not an obligation. Anyway, if you want to learn more about that, it's going to take more than me, trying to hit it in 2 minutes on a slide. But another interesting thing that can be done, and if, let's say, you wanted to buy options, you have to fill out a little bit of extra paperwork and show a little bit per government requirements to show that you kind of understand the process, that you're not just some knucklehead and get in over your head. So there's going to be a little bit of education you're gonna get before they will let you trade futures. Now, again, if you know say you know what you're doing, you fill out the proper paperwork, they approve your account, you get in over your head, you can't come back and try and sue them or something. But they at least try to warn you that you better know what you're doing if you're going to start trading futures contracts. All right, bonds. So bonds, this will be pretty quick. What we're talking about with bonds is as opposed to stocks. Stocks were an equity position. With stocks, you own a chunk of the company. With bonds, you are just lending that company money. Okay, you don't have any position with them. Bondholders don't necessarily, you don't have voting rights or any of that kind of stuff. Um, Theoretically, if the company goes out of business, they still owe you the money, but good luck trying to get that money from a company that's gone out of business. So your position in terms of insolvency is not great. Long-term debt securities, a lot of times issued by government agencies or corporations. So there could be, you know, private private bonds or government bonds. Par value, and again, just round numbers. I'm saying, let's say a bond is a $20,000 bond. That would be the par value. If you, maturity between 10 and 30 years. So let's say in this case it's 20. At the end of 20 years, it's a $20,000 bond. You will get your 20 grand back. And oh, by the way, you get to keep all the dividend payments that they paid you along the way. Now, you could also trade that bond, sell that bond on a secondary market before it hits maturity. But the value of that bond may not be 20,000 bucks. If the interest rates have gone up, meaning that other bonds are paying higher interest rates, nobody may want to buy your $20,000 bond. They're certainly not going to pay you 20 grand for it. They'll pay you 17 for it. Now you could keep it out to 20 years and get your 20 grand back, but by doing so, by keeping it that extra time, you're sucking up the fact that you're earning a lower interest rate than is available in the market. Interest, so the issuers are required to make interest payments and then repay the par value. So they give you those payments, and then they give you your 20 grand back in this case. There's also a call feature, not a good thing for you. Not all bonds have it, but what that means is, like I say, if you've got a bond that they're say paying you 3% on, and all of a sudden, interest rates go up and they're issuing new bonds, and in order to get buyers, they have to offer, say, 5%. Well, you're stuck. You can sell that bond at a lower price, or you can just suck it up and keep your 3% for the whole 20 years. Now, let's say another situation happens. Let's say it's a different time and place. Interest rates are higher. Let's say you're getting 8% on your bond, and all of a sudden interest rates start dropping. Let's say they can now issue bonds and only pay a 5% interest rate, a 5% dividend, and they're able to find buyers at that rate. Well, do they want to keep paying you 8%? No. They've got a call feature. They'll just say, yeah, deal's off. Here's your 20 grand back, and you're not getting your 8% anymore. So it doesn't work out for you. A call feature is not a nice thing for you, right? Feature that on a bond that allows the issuer to repurchase the bond from the investor before maturity. So what they'll say is, yeah, deal's off. Here's your money back. You're not getting 8%. In fact, you're getting nothing. You're just going to get your money back, and our relationship's over. Convertible bond. I don't typically own bonds, but you can get bonds that can be converted into shares. Not that prevalent in the market, but if you hear of a convertible bond, that's what they're discussing. That's what they're talking about. Bonds yield at maturity. So this gets into this whole thing I was talking about. where if the interest rates um, go up and you're locked into a lower interest rate, your the value of your bond is going to be worth a little bit less. If the interest rates go down, and your bond is say paying 5% and other bonds are only paying 3%, your bond could actually be worth more. Your $20,000 bond could sell on the secondary market for say 21,000. But anyway, with interest rates as low as they are, that's just not a situation we would be seeing. So bonds are traded in the secondary market, just like stocks and other things. That's what I was describing. They change in response to interest rates. And the same brokerage firms deal with bonds. So, 10 years from now, whatever, 5 years from now, things may change. Bonds may be a interesting thing. But when somebody says, oh, you should have some bonds, the question right now would be why at this point in time. 5 years from now, there may make sense, but there's no real case for buying bonds that I would come up with at this point in time. Types of bonds. Treasury bonds, again, very low risk. It's the U.S. Treasury, so the risk of default is very, very low. So the interest rate is going to be very, very low. Easily sold in the secondary market, but again, for me, it's just would be kind of a parking place, because these typically, with inflation as low as it is right now, these ones will probably not even keep up with inflation. Municipal bonds, some people really like them. Depends on your tax situation. Again, they're low risk, but they're exempt from federal income tax. And then federal agency bonds, interest is taxable, but again, very low default risk. Corporate bonds, subject to default risk, meaning the company goes out of business. And then high yield junk bonds. What happened during the financial crisis was they got a whole bunch of basically junk bonds, and they put them together and they made them, whatever, CDOs, or they had all these different names for them, collateralized debt obligations and other stuff. And their basic, didn't make any sense, was they said, oh, we get all this garbage and we put it all together, and now all of a sudden it's not garbage because it's more diversified. And it was garbage upon garbage. And so when it all fell apart, and the problem also was that they weren't represented as high yield junk bonds. They're represented as mortgage-backed securities when the underlying mortgages were, bunch of ninjas, no income, no job, no assets, people with no money who were speculating in homes, and when the market turned around, they just all defaulted. So hopefully it won't happen again. Corporate bond quotation, so the coupon rate, the maturity, the yield, the volume, closing price. So again, you could find all this data on a chart as well. So the company, the interest rate they're paying, when it's going to mature, the price, the yield, and volume. So hammering this home again, if interest rates rise, the value of your bond decreases. So when interest rates are near zero, all they can do is rise. So the value of your bond decreases. The situation we don't have right now, if interest rates fall, how can they fall? The value of your bond increases. How can the value increase? So anyway, tax implications of investing in bonds. Interest is taxed as ordinary income unless tax exempt. And selling bonds at a higher price. If you sell that $20,000 bond for $21,000, it's the same as a stock profit. Time value of money. So the necessity for, that's why we talked a little bit about taxes on this. The advantageous nature of, say, tax-free bonds um, depends upon your tax situation. If you're somebody in a low tax bracket, the desirability for having municipal bonds, not subject to taxes, is less because your tax burden is less. Now, if you're somebody, say, living in California with, a federal and a state tax of approximately 63%, if you're a high wealth kind of person, yeah, it might make sense for some of those situations. But again, you have to do, um, a little bit of math to figure out whether it's going to be worth it or not. And so, you'll look at different situations. I'll discuss it here in a second. Investing in bonds, so default risk, that means that the company just goes out of business. The ratings are done by Moody's, Standard and Poor's. And when I talk about the it's a letter scale, but it's definitely a grade inflated letter scale. AAA is, a good bond. B's and C's are down in the junk range. Impact of financial crisis, risk rating, and anyway, we all know what's going to happen in tough economic times, but um, you don't necessarily have a choice as you're going to be participating in that one way or another. So you can see what I'm talking about here. AAA is highest quality. A is only a high medium quality, and double B, anything below that, is into junk. So those ones down at the bottom, I mean, those guys aren't even paying dividends anymore. So you may think that you've got, this high yielding bond, but if the company's going out of business and not paying it anymore, then that doesn't really work for you. We talked about the call. Longer term bonds, exposure to more risk. Bond maturities, just when they're going to time out. So again, a lot of these things are just kind of moot points based upon the current interest rates. Matching up those. But again, buying bonds right now would just, you'd have to come up with an argument for why that would be a good idea. So what I was going to say about bonds is just one final thing is when you're looking at something that's going to be tax free, there's going to be a homework problem that's going to address this. But what you need to do is when you're comparing the interest rates, you need to know what your tax bracket is. So if I said, would you prefer a taxable investment that is going to earn you 10%, or would you prefer a tax-free investment that's going to yield, let's say, 7.1%? What would be, the better investment? Which one would show more profit? And in order to figure that out, to kind of do this in your head, you need to know what your tax bracket is. So in this case, I'm going to say your tax bracket is 28%. So meaning of that 10% you earn, you're going to have to pay 28% of that profit in taxes. So your net return on that, your net interest rate is going to be 0.28 minus the 10%. So we started out with 10%. We subtracted 28%, which is 2.8, right? And that means that your actual interest rate that you're earning is 7.2%, right? That's what you actually end up with after taxes. And I said your, for comparison purposes, the tax-free investment in my example was earning 7.1%. So in that case, you could, legitimately say, oh, I want to take the fully taxable 10% investment because I will make 7.2% using my, theoretical 28% tax bracket. So that's why you need to know basically what tax bracket you're going to be in, because it would affect the desirability of tax-free investments. So knowing the effect of taxes and income is important. All right. I hope I didn't lose anybody. I know a lot of this was without a chalkboard or something. It's kind of hard to express some of these concepts, but if you look at the homework, you'll see an example like that, and you'll see some similar numbers, and that's how it's done. Good luck. Hope everybody stays safe and healthy.